Welcome, everybody, to the Chinchilla Pickin' Podcast. It is December the 10th, 2023 at 4:15 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I'm joined by the Baron of Bonds himself, Brandon Beaver. Brandon, how are you?
I'm good. The NFL needs to move the Sunday night and Monday night games up to like 6:30, 7 o'clock Eastern Standard Time. Maybe 7 o'clock might be it, so the West Coast could still get their time in. But man, look, I got to leave here at 5:30 in the morning. Cowboys and Eagles game tonight starts at 8:30. I'm not staying up until midnight for a football game. I can't.
Well, I mean, there obviously are people who do, so that's why they do it. Yeah.
Saturday night would be a good time for the Sunday night games. Listen, the pay-per-view.
You can't do it Saturday night because most during the most season, college football's on Saturday night, and they would take the viewership.
Stop interrupting me, Dave.
I'm just saying.
Stop raining on my parade here. Is there college football on at 8:30 on Saturday night?
No, yes, there is.
Okay.
Yes, not right now because the college football season has ended, and we're about to head into the college football bowl season and postseason playoffs and all that.
Okay.
So, but yes, all the way up until this week, yes, there has been college football all day Saturday.
You think?
Anywho,
you think like Bowling Green University versus Wichita State would compete with Cowboys Eagles?
Yes.
Okay.
Because I prefer to watch that over the NFL game any day of the week.
Why?
It's better.
How?
It is.
We're gonna have this debate.
It's better. Anyways,
college games. Listen, like I don't even want to watch it 88-7.
It's not like that anymore. Too much. Sometimes it is. Sometimes it is, but not too much. Anyways, moving on. Thank you everybody who showed up for the Jingle Bell Run. That was part of our Chinchilla Picking team. Everybody, that would be one other person besides me. Everybody on our Chinchilla Picking team bailed, but we had fun nonetheless.
There was a medical situation with me, so I mean it was real. It was a problem, yes. And we had to take care of it. So
and I'm not guilting you or shaming you for not being there and supporting us, but I'm teasing. Yes, we had fun. If you saw us at the Jingle Bell Run, we were there. I was there, and there was one other person on our Chinchilla Picking team. If you want to be there for next year, let us know, and we got a year to plan it. So there you go. That's something we do every year. It was fun. We'll try to do a live event over the winter at some local coffee shop or local bookstore or something here soon. That way, Brandon and I could get out and be around people again, right?
People.
Right? Who does that? Seriously. All right. Anyways, back to the show at hand. You're not listening. You don't want to listen to us talk about sports or people or any of that. You want to hear about financial news and investment ideas and how can we make money right now? So let's get into it. Rules. Brandon and I get together 5 to 10 minutes before the show and we tell each other what we're going to talk about. You're to live back and forth, the bicker and the banter right here on the show for you. Brandon, take it away.
All right. So I just wanted to bring this up. This is a headline that I caught here because me and Dave, this is something that we've been calling for a long time. So Apple and its suppliers, they aim to build more than 50 million iPhones in India annually within the next 2 to 3 years, and additional tens of millions of units planned after that. And this is from the Wall Street Journal, by the way. If the plans are achieved, then India would account for about 25% of global iPhone production, and they would take further share toward the end of the decade. China will, at this point, remain the largest iPhone producer, but combined with other projects, Foxconn's investments in the state are likely to reach around $2.7 billion. So like I said, Dave, this is something that you and I have been calling for. Move out of China, go into countries like India and maybe even Mexico. And there's some logistics issues with Mexico and India as well. And there's some infrastructure issues there that need to be resolved too. But I think this is a good step in the right direction.
China's had a lot of issues this past year. I don't know if all of our listeners are aware that they actually went into somewhat of a mild recession in their economy, and they had some bad numbers coming out. It was mainly due to the real estate market just uh, collapsing in certain sectors of the real estate market. The Evergrande situation is, a reflection of that. So, yeah, there was a lot going on in China, and they really need to keep their business there. So the fact that they're losing business is not good. That's probably is one of the increasing reasons why they are looking towards Taiwan, because China's losing business. So right now, I would say I am not a bull in a China shop, and I am gonna stay out of that because I don't see long term growth in manufacturing in China just because of geopolitical politics and policies and tariffs and countries having issues with China. So there's a lot of third world countries that sign contracts, that those contracts are coming up, and not everyone knows the terms that these countries have agreed to with China as far as what they have to pay to get out of them. And so China, not everybody wants to get out of these contracts, is what I'm seeing and hearing in articles and news wires. That tells me that China's kind of losing its grip in a lot of the third world countries and losing its grip on manufacturing as it's moving to, like you said, India and other countries. So
they're going to have to rein themselves in if they want to continue to be the largest global player in manufacturing.
yeah, they are currently the dominant largest global manufacturing player in the world currently. But the trend is to move away from China, and it's just because of their geopolitical involvement in other areas and things they've said and done. And that's why you pay attention to geopolitical events when you're trading and investing, because it can affect it and you need to be aware of it.
Right. All right. And then so we move on to a company that we covered just 2 months ago. We did a deep dive into Pepsi back in October. So I'm not going to do a deep dive into it here, but I want to talk about risks and headwinds on Pepsi right now. A Jeffries analyst, I'm not going to try to pronounce his name because I won't be able to do it right, but he said Pepsi is the most durable business in our coverage. We expect Pepsi to outperform in risk-off environments and long-term by compounding earnings ahead of peers. Now, there's a headwind here that snack maker Mondelez International referred to from a certain weight loss drug that Dave and I, well, mostly Dave has covered here in the last few episodes. But he said that it's only a 0.5 to 1% headwind from weight loss drugs for the snack business in a decade. And assuming the high uptake of products, more than enough time to react to changing tastes. So did we overreact and selling snack makers in regards to Wegovy and Novo Nordisk? Go ahead, Dave.
So Wegovy is made by Eli Lilly, just FYI. Ozempic is made by Novo Nordisk. Those are the two ones that were diabetic drugs that are now weight loss drugs.
I got them mixed up. Okay.
It's okay. Everybody gets them mixed up. I just want to make it clear for everybody listening as well. Number one, yes, we all did oversell the snack makers because of this news. However, I disagree with you about the long-term effects. Currently, Novo Nordisk and Eli Lilly, neither one can make enough of their drugs to satisfy I'm drawing a blank here. Demand, thank you. Satisfy the demand that's out there for them, right? So as they build manufacturing plants specifically just to make these drugs, and they pump out more and more and more over the years, there's going to be millions more people taking them, and millions more people quit buying and being craving these snacks. So currently, yes, 0.5% is all that's be affecting it. But if they're able to build these manufacturing plants they're talking about, you can see that number jump to 2 to 4% easily, very quickly, if they have enough of the drug out there for people to consume. That's the reality. But right now, that's years away, though. That's the thing. That's years away. So right now, yes, we oversold.
All right. Stifel analyst Mark Astrachan. I don't know who Stifel is. It's just another person with an opinion that I thought was interesting. But He said, while early and still being evaluated, most packaged foods companies view the volume consternation surrounding GLP-1 drugs as overblown and having no short-term impact on their business.
I agree.
But here's my thing. We talked about Pepsi's supply chain and how advanced it is. If Pepsi makes more moves into the healthy food market, some of these acquisitions might be small and seem like they might not move the needle in the short term, but they have the supply chain and network and know-how to get these new snacks and healthier foods in front of the consumer. So I think Pepsi survives this and continues growing. Product volumes now, though they are down a touch in 2023 for Pepsi, they're in line with consumer staples companies. But Pepsi has lifted prices in the high single digits, and this enabled almost 9% sales growth for the first 3 quarters of the year. Total revenue next year is expected to grow 4.6% to $96.2 billion. Imagine having that amount of cash. $96.2 billion in revenue for Pepsi for next year. And price increases will moderate, but demand should grow just over 1%. They've also got $1 billion in stock buybacks, and earnings per share should climb about 8% to $8.15 next year. They have increased dividends over the past 51 years. And now the company pays an annual dividend of $5.06 per share. That translates to a 3% yield. Once again, going back into the deep dive from Pepsi, if you plan on buying it, look at our show from October where we did the deep dive into the company. It's very helpful. Go ahead, Dave.
I wanted to say, for those of you who are listening right now, I had my hand raised for like a minute here because I had a great comment, but Brandon would not stop talking. I cannot wait for my flaming hot kale chips. So
okay, flaming hot kale chips.
I'm just saying.
Awesome.
I mean, how are they moving into the healthy food and they think that that's all right? Look, Pepsi's going to be around 100 years from now. So is Coke. They both are. They both are in so many different brands. They're both going to be around. It's a great investment. It's a solid investment. I don't see either one going anywhere anytime soon. I just don't see it on the horizon. They have too much to. They have such a distribution system built in place that they could pivot what they make and just plop it right into that distribution system. So they have the infrastructure in place to easily pivot as quickly as anything else. So two great companies are going to be around. I know Berkshire Hathaway owns both of them, so it's definitely a company that they've believed in, and that's a successful investment company. So that's a good one to follow.
Well, if the people pivot away, start exercising, they pivot away from snacks. What are they going to drink? They're going to drink Gatorade, and that's a Pepsi product.
Not necessarily because, it's diet in and exercise, Gatorade Zero, yes. Yeah. But mostly water and protein shakes. Lots of water is what you see. People in the weight loss who are trying to lose weight, that's where they focus it at. So the Ozempic and Wegovy make you not crave high fatty, salty foods.
Well, you got to replenish those electrolytes.
Yeah.
You get it from Gatorade.
Or water.
And does water have? I don't think water.
Your body over time will replenish it. Water and foods naturally contain sodium. I don't add any salt at all to any of my foods whatsoever. I don't have salt in my house. You get enough salt in all the foods we eat in the United States without having to add to it to fulfill your daily sodium intake.
Well, what beverage are the Cowboys going to pour over Mike McCarthy when they win the Super Bowl this year? It won't be water. It'll be Gatorade, Dave.
They're not going to win. Anyways, moving on. Go ahead. Yeah. Moving on.
Where is Pepsi?
Are you buying Pepsi? Are you buying Pepsi because of this? No, this is a stock and investment show. Stop making it a Dallas Cowboys show because it's not. Are you buying Pepsi because of this?
Yeah, you got to dip into it.
You are buying?
And then where is Dak Prescott going to go after he wins the Super Bowl? Disney.
Are you buying Pepsi?
Yeah, I mean, I did a couple weeks ago. I told you, dip lightly into Pepsi and Coke right now. I think next year is going to be a tough year for everybody. I said that last year, but I guess I'm kicking the can down the road here. If
Here's
once it goes lower, buy more. You're going to be good for the long term.
here's my question: are you buying because of the dividend or the growth, or what are you looking at? Are you looking at growth in stock or what?
So if you want stability and growth and dividend, it's all in Pepsi.
Yeah, because I was going to say if you just want a dividend payment, just buy Altria.
Nah, I wouldn't go
That's a
there.
10% dividend right now. 10% dividend. You're guaranteed 10% a year if you buy it right now.
Well, unless you lose 20 on the stock end, then you're down 10%.
You just don't sell; it'll go back up.
I don't know, maybe. But anyways, so
I
here,
mean, well, Altria has been at the same price range, 40 to 50, for 10 years now. Hasn't moved. Dividend
that's not
is at 10% yield. 10% yield on the dividend.
okay.
I
But I
mean,
think
yeah, I'm just saying. I'm like, if
it's all
you want safe, secure stocks, I could give you a handful of them that are going to be safe and secure and just going to guarantee you your 5 to 10% a year. That's not my goal. I want to teach people how to make 5 to 10% a month off of investing and trading, and that's where my goal is. I've always been that. I've always said that. I'm a day trader at heart. I do have long-term investments now. I didn't always, but
Yeah.
I mean, everybody has different objectives and goals and what works for them.
Well, I think those dividend blah. I think those dividend aristocrats are going to outperform over the next 12 months.
Right. A good dividend play is Microsoft because I believe the company is going to go higher. I believe the stock price is going to go higher in the long term, and you're going to get that dividend every 3 months.
Well, if interest rates go up, tech stocks are going to suffer again next year. This year, it was great for tech, great for growth, bad for defense.
A
I think we're flipping the switch this coming year.
All right, so we've covered this before in previous podcasts. AI is what drove tech stocks this year. AI. That was the big buzzword of the year. I mean, if you did one of those things where it pulls out the most commonly spoken word, right, and you plugged in everything that was said on CNBC, Bloomberg, Cheddar News, all the ones out there, Fox Business, all those business stock news channels, AI is probably number one biggest.
Sure.
That's what drove the tech industry this year was AI. But there was actual real numbers behind it. NVIDIA posted great numbers because of it.
All right. Well, here's the thing. All right. So when I'm talking about having a tough year next year, hard landing, all that stuff, there's two sides to every coin. So I want to try to cover both. Okay. There was some good news over the past week, actually, that was buried over the initial headlines and such that suggested maybe the soft landing has already happened. Maybe we're going to recover and come out of it. And this was productivity. Productivity of American workers rose by a revised 5.2% annual rate in the third quarter. This is the fastest pace since the third quarter of 2020. And that's a big deal. I mean, we were coming out of the pandemic when half of the country was shut down. But excluding the pandemic era, it's the fastest since the fourth quarter of 2009 coming out of the recession. Over the past year, productivity has increased by a revised 2.4%, following a 1.2% gain in the second quarter. These are the first two straight quarters of productivity growth since early 2021. Good news for many reasons, but one reason is that it could help contain wages. We're getting more efficient again. It could bring down inflation without a sharp rise in unemployment, talking about the soft landing. Other economists and Federal Reserve officials, including me, by the way, is saying that it's too soon to know for sure whether this is sustainable. However, there's a second piece of good news here. The service economy is continuously in expansion mode. The ISM barometer of business conditions at service companies such as restaurants and hotels rebounded back up to 52.7% in November from a 5-month low of 51.8%. Anything above 50% on these ISM barometers, and we've covered this before, but anything above 50% suggests expansion. Go ahead, Dave.
So, Mike, I want to see that restaurants and hotels separate. And here's why. I believe hotels had a great jump, right? Everybody started traveling again. I don't think restaurants was as big. I want to see those two separated and then tell me the numbers.
Well, I feel like both kind of had a post-pandemic increase that we're still experiencing right now because people were starved for experiences. And that was the whole reason why retailers were given that they had all this apparel back stock that they couldn't get rid of because people were spending all of their money on going out to eat and going traveling. And I think that's still kind of happening here. So I think these numbers might be a little bit skewed.
Gotcha. But I think the hotels saw a bigger increase than restaurants.
Yeah. So I don't have the particulars here, but 15 industries reported growth in November. 3 industries reported a decrease in activity. The buildup for the holiday season, the ISM says this, it's not as robust as it has been in the past, but so far better than last year. Respondent in the transportation and warehousing sectors said that there was solid activity heading into the final stretch of the fourth quarter. This is good news for the economy overall. We covered the fact that the transportation and warehousing industry, the logistics industry hits a recession. Transportation and logistics hits a recession usually before the overall economy does. So if they're experiencing a rebound, maybe we had the soft landing. The downside here to this for stocks is that this means higher for longer. Still, those high interest rates, not going away. I really don't believe in a soft landing yet. I don't think that's going to happen yet, but go ahead, Dave.
All right. All right. Couple things here. Number one, you mentioned transportation industry is seeing a rebound. Here's some of the things that you have to take into consideration, and this is more for our listeners. When you're hearing about a rebound transportation industry, first of all, number one, FedEx Ground had shut down a lot of warehouses around the country. They furloughed their workers because in order to cut costs, they cut labor costs. They shut down smaller hubs and then consolidated it to the bigger hubs. That's not well known. They didn't publicly always announce that happening, but they furloughed them. They didn't fire them. That was a couple different things there. A lot of those FedEx drivers that were line haul drivers and were not direct hires of FedEx, but third party, went out and started working for other companies instead. However, another headwind for the trucking was Yellow. Yellow disappeared. That was 30,000 jobs. That was 20,000 trucks. That was a lot of LTLs. That was a lot of business. So when you have all these parts of the shipping industry disappearing, well, it means the other parts that are still around are going to pick up business. Why? Because they're picking up the business that these other parts did. Does it look like a rebound? Yes. Is it a real rebound? I don't know.
I don't know either, and nothing ever goes in a straight line, so it could just be a short-term bounce.
And it could just be because of all these other effects taking place in the industry, a consolidation, if you will, of all the of everything that's moving through the pipeline. It's consolidation of the pipeline, not necessarily companies. Companies are consolidating their pipelines.
All right. Well, you know what? If I can go the rest of my life without hearing the word furlough, I would be super happy.
Well, I mean, I say that because, yes, transportation usually rebounds before the rest of the economy. Transportation usually goes in decline before the rest of the economy. But when you have a weird events like we've had this year with companies like FedEx just, shutting down smaller hubs, Yellow disappearing, all these other things, it kind of skews that number. And so it's not as reliable as it was in most years, right? Yeah, it's still something to look at and gauge. And this is why us on the show here in Chichilla Pickin, Brandon and I both agree on this. We may not always agree on everything, but we both agree on this. You have to use more than one tool, more than one set of numbers. You can't just say, all right, I'm just going to trade specifically off the PE ratio. No, you got to use it in conjunction with other numbers and tools here in order to get a good picture, a fundamental picture of the company you're looking at.
Yeah, I agree. And you also have to take other things into effect when it comes to the overall economy, right? So we're looking at right now inflation continuing to run at 5%. Bond yields at 4.5% now because they've come down with lowering inflation expectations. But that doesn't make any sense to me. If you're at 5% inflation, yields can't stay at 4.5%. We got to see continued downward pressure on inflation. If inflation continues at 5, we're going to have to see a rise in yields. Let me give you this example. If inflation runs at 5%, and then we get yields to 7.5%. People are making 2.5% as a profit, right, on that per year. If yields are at 4.5%, that jump to 7.5% would not be good for the equities market. We would have a pretty thick bear market. This is actually something that Nouriel Rubani, he's the author of Mega Threats, his book that came out last year. He's a perma bear, but I think he's making a good point here. 7.5% in bond yields does not do well for the equities market. That's a pretty big sized bear market that would probably cause everywhere. And I think that Europe and the United States and Asia, we're all susceptible to this. This is a big threat to the globe. And we're at a situation right now, especially if yields start to rise again, deficits continue to matter more and more and more and more. And if we're continuing to borrow as a country to pay off new debts and new spending projects that we want to go on, I don't think that bodes too well for the global economy.
It doesn't bode well at all if what he's saying is correct. If we're going to hit 7.5% on the yields, going from 4.5% where we're at now, 4 to 4.5% where we're at now, depending on which yield you're looking at, and jumping all the way up to 7.5. Yeah, that's a big jump. And if he's talking about doing it in a short period of time, that's going to be devastating for the equities markets. But it means if you start seeing that happen, cash out, wait for everything to drop, buy in, make a ton on the way back up, because a lot of these companies are going to be brought down that are good companies and do not need to be brought down, and you could buy some cheap deals, but you have to see it come and know and be aware of it and to cash out and buy lower. That's the thing to look for in situations like that.
Yep, it'll be raining blood and hellfire on CNBC, but you got you got to get your guts together and buy up when there's blood in the street.
I think there'll be a huge again, we're talking about a hypothetical situation, but it would be huge to the regional banks is where that's going to hit the hardest.
Yes,
because they still have exposure. They still have too much exposure.
And commercial property markets across the world, probably more so in Europe and Japan, where they've had those zero rate policy for just about forever, and that's not sustainable now. We know that. It would hurt them even worse. I think Asia and Europe gets hurt worse than us, but it's still going to be a problem for the United States, of course.
So give me your thoughts, since we're talking about this. CPI report comes out on Tuesday. What are you looking at as far as the number? Is it going to be below 5%? Is it going to be at 5%, staying flat, or are we going to go up even higher? Based off everything you've seen as far as the numbers and the news for the past 30 days, what do you think it's going to be at come Tuesday?
I mean, who knows? But analysts are expecting it to stay flat. I think it stays sticky at 5%. And that can't stay that way for the long period. I mean, a CPI number at 5%, not that big of a deal this time around. But if that continues to happen and it stays sticky at 5%, then we got a problem.
So if it stays at 5%, what is the Fed going to announce on Wednesday?
Higher for longer.
So just not raising, but higher for longer. See,
Yeah,
I say
I don't
if it's
think
5, go ahead.
I don't think you can react off of just, one or two data points. I think you got to let that flow in a little bit more.
All right. So look, I know Jerome Powell says that, but Jerome Powell and the Fed have not raised rates for the past, 3 months now? They've kept it flat.
Yeah.
If we see 5% or higher, they have to come out and say 25 basis point raise. And if you see that, the market's going to drop like a rock.
Okay.
But I believe that if it's 5% or higher, Jerome Powell and the Fed, if they don't come out and say 25 basis points, if they say we're just staying where we're at for now, I think that's a bad move. I think that's not the right move. I think that's going to allow inflation to creep back up again, and they're not controlling it. And so I'm sorry, I'm very staunch on this. I'm very hard on this because I believe that Jerome Powell is. I like what he has said. He has said he's going to control this. He's going to get it done. He's saying the right stuff. But if the CPI number comes out on Tuesday at 5% or higher, he needs to actually do the actions too and do a 25 basis point raise. So I believe that, since based off his last comments, I think that we're actually going to see inflation go lower because he has access to information that we don't have. Last week he was on, I believe it was last week he was on TV based off of his comments, I believe we're actually going to see inflation drop below 5%.
Okay. I hope so. That would be very nice. It'd be a very good thing to see. As long as it's not bringing down the rest of the economy with it, I'm great with it. And I do want to say this, that look, there's always uncertainty in the market. There always is. You can't really let it, you can't let it make you panic, but that's why we always, every once in a while at least, go and do this whole, where are we now? Let's manage our expectations for the next 12 months. Let's figure out what our headwinds and tailwinds are so that they don't come and surprise us.
And I agree. You have to manage expectations. You have to look at the numbers. You have to let it guide you. Don't look at the numbers and have and be looking for what you believe it to be in the numbers. Look at the numbers, let them tell you what it is. It's how you look at these things in the perspective of it is how you're gonna get to the right conclusion. If I go looking for the bull case every single time, I'm gonna find it no matter what. I could twist numbers any which way. If I'm looking for the bear case, I'm gonna find it. You could twist numbers every single way. The thing about me, and this is what I pride myself on being consistent here, is that I have switched back and forth between bull and bear at different times, and it's because I allow the numbers to tell me what it is. And I let the numbers tell me, and then I make my point based off, okay, here's what I'm seeing currently. So right now, yes, right now I'm bull, but I've always said I'm looking for certain things that would switch me back to a bear again. But right now I'm a bull.
Okay. I think you're probably going to get a Santa Claus rally for the next 2 to 3 weeks, but I don't want anybody to buy it personally. I don't want anybody buying a rally if that happens. Why would you buy a rally? Anyways,
yeah, if we have a Santa Claus rally, it's going to sell off in January. Number one. Number two, you're not going to get a Santa Claus rally if the inflation report comes in at 5.5%, right? And the Fed's raising rates on Wednesday, so that you're not going to have that Santa Claus rally. So we get through Wednesday first. If there's no Fed raising rates and inflation is flat or gone lower, then you're going to have your Santa Claus rally. But I believe it sells off in January.
Gotcha. Let me check my notes. I think I'm done here, Dave. Yep, I am. I'm handing it off to you.
Handing the baton to Dave. Nice. The one who was at the run. All right. So let's go in here. Let's I got a few things to go over. I already mentioned somewhat about the economic calendar. We're going to be looking at the CPI report on Tuesday. It's going to be at 8:30 a.m. before the market opens Tuesday morning. Take a look at it. Be ready for that. The FOMC meeting, they begin at that time. Then they have their announcement at 2 p.m. on Wednesday. That's going to be their announcement. And the Fed chair, his press conference is at 2:30. So that's what everybody the whole week is going to be pivoting off of, everything that goes on there. Thursday, we see the Fed balance sheet. So, you got some numbers coming in there that we're all looking at, and some indexes and industrial production. If you don't know where to go to find the economic calendar, if you have a Fidelity account, and this only works on desktop version, I don't know how to get to it from a mobile device, cell phone device. If you have a Fidelity account, you go into news and research, you go down to market and sectors, and then once you're on that page, there's going to be a little icon that looks like a calendar. You hover over it, it says U.S. Economic Calendar. That is going to actually tell you exactly what's going on in big announcements in the economy every single week, week in, week out. I utilize it all the time. I recommend anyone else to utilize it as well. So I'm just trying to be helpful here with that. All right. Cool. Brandon, you ready? Here we go.
Yeah,
Headlines. We already started talking about it. You covered it a lot, so I'm going to skip it. I had one about the week ahead and what's going on, and where everybody expects it to be for U.S. equities and everything like that. But we can skip that for now because we've already covered it. Man, you're just killing me here. This one here is this is on CNBC.com. The headline was written by Devin Burris. It reads, how grocery stores are becoming data brokers. Grocery stores are becoming data brokers. It goes in here to talk about how we all have known that Facebook and Instagram sell data, right? That's how they do it, advertising and selling data. We've all seen now Instacart making money off of selling advertisements and data. They gather your data, how you shop, and they sell it and say, hey, you want to sell cereal boxes? Well, person A over here buys a lot of cereal boxes. You might want to sell to them.
Yeah, we talked about Instacart's partnership with Pepsi in that regard.
Right. So, I mean, a lot of companies are moving this way, and it's really affecting the consumers because a University of Pennsylvania study found that 79% of Americans feel they have little control over what marketers can find out about them. Experts are calling this data fatigue. Consumers knows their data is being collected and they feel like there's nothing they can do to stop it. But grocery stores are the latest in the string of companies trying to make money off of this. In 2021, the data broker market was valued at an estimate of $319 billion. That value is expected to pass $545 billion by 2028. In the past, retailers would buy data from data brokers to get a better idea of consumer trends. Now they're cutting out the middleman and they're collecting it themselves. Thoughts, Brandon?
Well, you know what? If they can use that data and sell it and use that to bring down the price of bread and eggs and groceries at the grocery store, I'm fine with it.
I mean, you have that, and you also have maybe only stop buying eggs and that nobody wants to buy, and only stick with the eggs that everybody likes. Or you'll know, like in these in this part of town they like these eggs, and in this part of town they like those eggs. You know what I mean?
Yeah.
They become more efficient. So then, yes, the whole cost will hopefully rebalance, but I doubt it. Most of the time, once it
look, if Kroger and Walmart get into a price war, or essentially it's inevitably going to happen where there's competition from Aldi or somebody, and Kroger has to bring down their prices, they've got that cushion to do it now.
They do. You're right. If there's a price war, that would be the only thing that causes that, because typically once prices of say milk goes up, it typically stays up. They don't lower it back down. But yeah, price wars will have that effect. Cool. Moving on. Here we go, man. This one is by Terje Scholviks out of Reuters. Came out 5:33 a.m. on 12/9. The headline reads, Norway Wealth Fund pushes Tesla for union recognition and will keep its stake. So there's been this news lately about Norway and the Scandinavian countries and Tesla, and how Tesla is not they're fighting back against the union, the collective bargaining in these countries. Tesla's just saying, well, we'll just hire different people. That's just basically what they're saying. They're saying you don't have to work for us if you don't want to. We'll just hire somebody else who will work for us. And they're not liking that. So they're trying to find ways to force Tesla to accept unionization in these countries. One of the ways they're trying to do was a Norwegian Bank Investment Management. It's the world's largest stock market investor and Tesla's seventh biggest shareholder with a 0.88% stake worth $6.8 billion. Said on Saturday has no plans to divest its holdings from the company, unlike other funds. We expect companies in which we invest in to respect fundamental human rights, including labor rights, they said. They're hoping basically to go ahead and change Tesla from within and kind of sway them to allow the unionization in these Scandinavian countries. The 2022 proposal, which NBIM said was supported by 32% of those who voted, called on Tesla to adopt a policy respecting labor rights such as freedom of association and collective bargaining. My only problem with that, Brandon, I'm all for if people want to unionize, right? I've been very vocal that I used to be a union steward and a member of the Teamsters. If that's what you want to do, that's what you want to do. But you can't say you have a mandate when you only got 32% of the vote. That's not a mandate. That means you lost. The mandate's the other way. The mandate is most people don't want to unionize in that company, and they want to keep it the way it is. Thoughts, Brandon?
What's to stop a worker cooperative? With those 32% that want to unionize, instead of going into a union, why don't they just band together themselves?
Right. Yeah, seriously. That's one way to do it.
But here's the thing though, look, if you're the company, if you're Tesla, and I'm not saying this is what Tesla does, but I think that they've been rather infamous for 60, 80 hour weeks, and such, and people sleeping on the factory floors. I don't think that's happening as much now that they're more up and running and that they've got their supply chain and everything like that going. But if you're a company that's facing union threats, all of a sudden you adopt work-life balance and start respecting your employees' time off and respecting the fact that they have a life outside of your job. Once you abandon the idea that is not true anymore, that if somebody gets fired or quits from your workplace, that they have to go and work at the ice cream shop down the street. Once you abandon that, then all of a sudden your employees are happier, and a lot of your union worries go away.
I mean, there's that too, but we could go down a hole here on union, non-union, because I also believe in, like, why haven't the financial workers at Goldman Sachs unionized? Because they work long hours. The reason is they get huge paychecks. So sometimes, yeah, you may be working long hours, but your pay is worth it. Tesla could pay more because they don't have to pay pension benefits. They don't have to pay the same health benefits that GM and Ford do. So they pay a higher hourly rate. Sometimes that's worth it more to people than those other things are. The Goldman Sachs workers that come out of college with their master's degree or doctorate degree in finance, and they come out and they work for Goldman Sachs for 4 years. They have these alarm clocks they sell that, will go off once they've hit their 4-year mark, and they can take their paycheck and leave. But they get no sleep for those first 4 years. But for them, it's worth it. They get the experience and they get the big paychecks. And sometimes people want that.
Yeah, yeah. I'm just saying though, like you get out. Me and you've probably had this happen. You go to your car and then there's a pamphlet from a union sitting on your windshield there. And if you're working for a good company that provides good benefits, gives you a decent amount of time off, you just throw that away.
Yeah.
But if you're working for a company that's got you 60 to 80 hours a week, gets mad at you when you want to take time off and doesn't pay you enough, then you're giving that thing a second look and maybe putting that phone number in your contacts.
Yeah, and I agree. And it comes down to that last part, doesn't pay enough.
Yeah.
Because people are willing to put up with that if the pay is right.
Sometimes.
I guarantee you can always find someone willing to put up with it if the pay is right. Guarantee you.
Well, maybe
you just got to pay high enough.
Yeah.
All right. So that was all I had as far as articles. I wanted to cover a couple stocks that I've mentioned before and where they're at now and kind of where my track record's been this year with them. So the first one I want to cover is Tesla. I started buying Tesla at 256. It dropped. I bought over 50% of my shares around 250, 256, but then it dropped down and I bought lower. I did not get the cost basis down as low as I wanted to, but I got lower to where it's at now, to where I am profitable. This goes back to my current method of long-term investments, where I divvy up how I buy in over 10 different payments, 10 different weeks, and I buy in 10% at a time. So far it's been paying off, because lately every time I go in and I create a position, the company has dropped, right? And I'm always like, great, here we go again. It drops, but then it goes back up. I know, Brandon, you had this happen with Meta and everything. So my advice to people is, if you're going in for a long-term position and it drops right away, you did the research, you thought about it, and you said, this long-term position is a good buy for me. Don't start doubting yourself. Sometimes the market just moves that way. You did your research, trust your instincts. You did all the work. This is a good company. Go ahead and continue to buy in if you can. If you're all in at this time, just write it out, because eventually in time it will go back up.
Right.
I did that with Intel. I just wrote it out because I put all in that I wanted to put in. Eventually, I made a profit off of it. I sold. It wasn't as big profit as I wanted for as long as I held it, but I still made a profit off of it, and it got out. And Tesla, I'm currently profitable. I'm holding that for longer. And then Novo Nordisk, I'm currently down, but I believe in this company. I believe because of their long-term future growth is going to be tremendous, because just the need for these drugs that they're producing. It's not just the weight loss, it's improving cardiovascular health. it's the diabetes is still growing in that sector as well. There's a lot of other uses besides weight loss, but the weight loss is great for a lot of Americans who are obese and have drinking problems. This is a could be a solution to them. So I believe in the drug for that regard. I will say a lot of the oil companies like Schlumberger and Rig Transocean did bounce back up off their lows that they were in, but I would not be too bullish on them. I know the oil companies are down. ExxonMobil was over 105 at one point off of that news that I reported on 2 weeks ago, that they had that good news coming in for just Exxon itself. Uh, but it dropped back down because the price of barrel per oil dropped tremendously this past week. It just fell off a cliff. And so now it's down around $99. So am I saying this is a call at this level? No, because right now America's switching to their winter blend we've already switched to the winter blend of gas here. Inventories are still high as far as gasoline inventories. Oil itself inventories are a little bit lower, but I believe they're going to continue to stay right where they're at. And as long as gasoline inventories stay high, I don't think we're going to see too much change. You're going to stay within a 1% to 2% range of where we're at now without any other news interfering with it with oil. So that's where I'm looking as far as that. Bitcoin, I'm still looking forward to the halving event coming up next year. It's just an estimate. People are estimating it's going to happen between March and April. I believe you're going to see so maybe it's going to be hard pressed for some of these smaller mining companies to make money off this halving event. However, some of the bigger ones might do well. So you might get like a Riot move up as the price of Bitcoin goes above 60, 70, $80,000 a coin, because now there's less of them being made. It's supply and demand. That's why these halving events are big movers of the price of Bitcoin, and it's an opportunity for you to make some money off of it if you have some cash on hand to currently buy in. What I'm saying, though, is be very careful about which ones you buy into. Any one of these mining companies could go extinct next year around that time, but any one of them could also double in price. It's very risky. Very risky. Do your research and make sure you found a good one that's going to be here. Brandon, go ahead. Thoughts?
Yeah, I'm gonna piggyback a little bit off of what you said about the trusting your research and stuff. Look, before you go into the market, you really should be reading books and you should be doing the paper trading and all of that stuff. If you didn't do that and you don't have any research into it, then you probably shouldn't trust what you've done. But if you did, and you did the research, and you'd be confident. And sometimes it takes years in the market to get there. Sometimes it does. Sometimes you're going to doubt yourself. But try not to. Try to stay calm and try to stay persistent.
Yeah, I want to remind everybody listening right now, because we don't talk about our credibility or our experience too often. But Brandon and I've been doing this for years. Brandon, I remember when you first started, you read the books, you did the work.
Yeah.
But then you started day trading options for like a year. And now you would come up one day, man, I'm up 80%. The next day you're in, I'm down 200%. What's going on? And it was crazy. And I was just like, wow, what are you doing?
I really just wanted to get good at it. And it took me 2 years to get good at it. And then I realized that I can make the same amount of money just investing.
Yeah, exactly. That's what a lot of people don't realize. I think for me personally, I started as a day trader and then I had to learn investing. I enjoy day trading, but I've realized that I can enjoy it and I'm pretty good at it, but it's hard for me to teach it to people. It really is. And it's no matter how hard I try to teach it to people, it's not most people will fail at day trading.
Mm-hmm.
But you could teach investment to people, and most people can be good investors if they listen to you. If they listen to you, they will be good investors.
Yeah, if they get their mind right, if their mind is right, I just said earlier in this episode, why would you buy a rally? And you might buy a rally if you're a day trader or a swing trader, but if you're an investor, it doesn't make any sense to buy a rally. There's no sense in buying hype.
Right? Exactly. All right, Brandon. Time for final thoughts. Tell me what you got going into next week or maybe the next month or two. Who knows?
Next month or two, I'm just looking at that CPI data. I'm watching that, and I'm watching the service sector, and I'm watching the ISMs. that I just told you about earlier in the show to see if those were one-off events. Obviously, the service sector is not a one-off event. That's been 11 straight months in the making, but is it now long in the tooth? We'll find out.
There you go. Here's one thing. If you have cash on hand, I would say wait till after Wednesday. Wait till after Wednesday to invest it, because you don't know what the CPI data is going to come out as, and then you don't depend on that. It's going to make sway the Fed decision come out Wednesday, and that's going to move markets because
Right.
everybody's right now moving based off the Fed decision. Whether or not I agree with it or not, that's just the reality of the market we're in. So you might as well at least wait until you know which way the market's going before you put that cash to work for you. So if you're sitting on cash, my only advice would be wait till after the announcement on Wednesday to know which way the market's moving. That way you can move in the right direction one way or another, unless, of course, you have those long-term investments that you're going to hold for years and years and years. Then it doesn't matter when you put it in because you're holding it for years no matter what.
Exactly.
So Novo Nordisk should be one of them. If you want a good investment, Novo Nordisk, I still believe in it. I still am bull on that company. I believe everybody's going to be on either Ozempic or Wegovy here soon because Pfizer can't copy it, and that's why Pfizer keeps going down. Pfizer's a dog with fleas right now, and it's getting worse. It's getting worms.
Well, we'll see. I don't know. I'm still holding on to it right now. Just to
You're gonna hold on to it until it hits $10.
No, I don't think I will. I think they've got enough. They've got enough cash in, and I think it. I guess we'll see next week if I sell it or not. Well, see, this is the thing about doing long-term investments, though. Sometimes it takes time to make decisions.
There you go.
It's still half of what I was saying before, and half of my thesis is true. So now I'm still like kind of weighing my decisions,
Right on. All right. Thank you for listening. Please hit the subscribe button if you like what you hear. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.